Are you trying to figure out where the money is going to come from to buy your next investment property? Or you own a business and you need access to capital. Did you know you could get a home equity line of credit on an investment property, specifically a DSCR HELOC that uses the property income to qualify, not your personal income? That is what I'm going to be talking about today. The R in the FROG method I teach. FROG stands for first home, reinvest, own more, and grow wealth. So today we're going to talk about the DSCR HELOC and how you can reinvest the equity in your investment property to own more and grow wealth. So what is a DSCR HELOC? It's a line of credit backed by the income of the property itself, not your personal tax return. That is key, and that's a huge benefit. If you own investment property and you're looking to expand your portfolio or even expand your business, this may be a good loan to consider. Most homeowners understand the concept of getting a home equity line of credit, commonly known as a HELOC. A HELOC is a line of credit secured by the equity in your property. I call it a large credit card that you should use responsibly. A traditional home equity line of credit and a DSCR line of credit work exactly the same way. The difference is how you qualify. With a traditional HELOC, you need personal income documentation, usually 2 years of tax returns, and you have to qualify based upon your personal income and your personal debts. Well, the beautiful thing about using a DSCR HELOC is that it's based on the income of the property and the debt of the property. So R stands for debt service coverage ratio. So in short, the rental income has to cover the HELOC payment and any other debts on that property. So let's talk about who this type of HELOC would be good for. A person who owns rental property and does not have traditional income, or someone whose debt to income ratio does not qualify them for a loan. And your debt to income ratio is simply the money you have coming in versus the debts that you owe going out. And so if you owe more income than what you have coming in, or you don't qualify, that can affect you getting approved for a regular loan or a traditional HELOC. So a DSCR HELOC is something to consider. Now, how we structure it and whether your property actually qualifies, that is the part my team and I look at with you. So let's say you want to buy another investment property, but now you need the money for the down payment. The funds from the HELOC may be able to be used towards that purchase. That is just one use. Maybe you own a business. You have a project coming up and you need capital. The line of credit may be another source of the funds for the business. The goal is to reinvest the equity to help you continue to grow your wealth. Basically, reinvesting your equity to build your wealth on purpose. I work with a lot of people who are looking to scale their real estate portfolio, and a lot of my clients are self-employed. The strategy we use often for my self-employed clients who own rental property is the DSCR loan or the DSCR HELOC. Now they have funds to expand their real estate portfolio, but a lot of the times it is used to expand their business as interim financing. There are a lot of different uses for the funds you have access to with the DSCR HELOC. But what is really important to take away from this is to use any debt responsibly. I enjoy leveraging debt to build and grow wealth. That's how I expanded my real estate portfolio. I believe it's the fastest way to grow your wealth. So I do not teach anything that I don't implement myself. But just because you have equity doesn't mean you should use it automatically. That is where people can get themselves into trouble. The money is not free. You are borrowing against an asset you already own. You are borrowing against your investment property. So there is going to be a payment. The property still has to make sense. The rental income matters. The amount of equity matters. Your credit matters. And how the loan is structured matters. So before I tell somebody to use equity, I want to know what the money is supposed to accomplish. That's key. If you are using it to acquire another property, we need to understand that transaction. If you are using it for the business, it's important for you to understand your payback strategy, because having access to money and having a strategy for the money are two different things. So before you borrow against a property you already own, I want you to answer 4 questions. Number 1, what exactly the money is used for? And be specific, not I just want to have some cash available. What are you actually trying to accomplish? Number 2, what should this money create? If you are drawing $50,000, what difference is that $50,000 going to make in building your real estate portfolio or building your business? Whatever you're going to use to create income, are you improving the property? Are you funding a project? Are you positioning yourself for the next purchase? The money needs a job. Number 3, what does the new payment do to your numbers? We cannot just look at the money coming in. There's an obligation we are creating. How does that payment affect the cash flow on the property, and that you plan accordingly? Now, does what you expect to gain justify the debt? Number 4, what is the repayment plan? How does this money come back? What happens if the project takes longer than you thought? What if the rental sits vacant for a couple months? Those are questions that build the strategy before we create the debt. Does that make sense? Now, let me tell you where I stand on this. Equity is an asset. It is not extra spending money. I am not against using it. I believe in leveraging debt to grow wealth faster. What I am against is borrowing against something you own with no plan. Cash is king. We all know that. I am an advocate of you keeping reserves because life happens. So when we use the equity, we use it on purpose. The mortgage is the vehicle, but you have to know where you're going first. As a money strategist and a loan officer, my first question is, what are you trying to accomplish? Does this fit into the picture you are trying to build? Once I look at your numbers, then I put together a strategy. My team at Optist and I run the numbers, we structure the loan, and we close it. Business purpose and investment loans is what we specialize in, and we do those nationwide. A lot of people learn a strategy in one place, then they take it somewhere else to get it done. And the person doing the loan never heard the plan. That is usually where the plan gets lost. My name is Fannie Mae West. I'm a money strategist who happens to do mortgages. So if you own an investment property and you have been wondering what that equity could do, let's map it out. I teach the Frog Method live every month. Information is in the description below. And if you want to look at your own numbers with me, the booking link is down there as well. Bring me the property and let me see what we can do. And before you go, please do me a favor. If this helped you, go ahead and like and subscribe so you don't miss the next one. Then share it with another real estate investor looking to build their portfolio.